Welcome to the week ahead for financial markets. Mike Smith, Senior Analyst and Head of Client Education and Training at Go Markets. To lead you around some key factors that are going to dictate market sentiment this week, we've got five for you to discuss. First of all, of course, we are seeing a little bit of a technical tip over for the major indices. We started the year week following on from a disappointing Santa Claus rally over Christmas, and things are looking a little precarious for the major indices. If we look at the Nasdaq, for example, you can see here this technical, what looks a little bit like a triple top formation. Whichever way you slice it, there is a key level that we've now breached, and Friday's price action was most certainly bearish, has pushed us down to a closing low not seen since the 27th of November. Further selling potentially to come. It does suggest that the buyers are no longer in. We have some significant events this week, which we're going to talk about in a moment. But the next key level, should we continue to see selling, will be down to around about this 2600 level on the futures contract. One of the key factors in that market sentiment this week is going to be US CPI due out on Wednesday night. We are expecting a potential tick up from December's number, and already the market is pricing in that the Fed is going to pause, potentially until March, but a higher number could push them further away again. So that number is pretty critical, not only in terms of market sentiment as a whole, but also other asset classes. Just to add to the mix, we've got US earnings season kicking off, a company reporting Q4 earnings. To be fair, the last few earnings seasons have beaten expectations significantly. Watch particularly this time forward guidance, even if the numbers are good. There may be some uncertainty in light of the fact that we're getting a new president in the US inaugurated imminently, and the potential impact of issues like tariffs, etc., that we've discussed before. We start off, of course, with the major banks, then ramp up over the next 3 weeks. In the Forex world, we're seeing a continued surge in the US dollar, high bond yield supporting 2-year highs for the USD. Let's just have a quick look. So if we put it on a monthly chart, you can see the last time we were up here was November 2022. We breached any reasonable technical level, and you can see that push through here. If we're looking at it on a daily chart, you can just see really since the back end of September, we've had a series of events which have pushed the USD to the upside. And of course, right now it's bond yields, which have been influenced, of course, by pullback from the Fed on their continued rate cuts. And finally, one would suggest that the USD would have a negative impact on gold. But because one of the drivers of gold is as an inflation hedge, we are seeing some buying coming into gold. If we look at a chart now, you can see there over the last 3 weeks, we've had a bounce of around this key psychological level of 2600. This move on Friday to breach this resistance looks technically significant and looks as though we might retest those levels we hit in mid-December and mid-November, respectively, of around about 2730. Wouldn't surprise me to see that breach fairly soon this week, particularly if that CPI number is a little stronger than expected, perhaps even back to these record highs just beneath 2800 is on the cards. So there's five things which we think are really important this week. Don't forget, of course, hop into our live market updates and charts of the day at 12:30 p.m. every day Eastern Time. And of course, our Inner Circle session on 8 o'clock every Wednesday with not only a look at live markets, but also, of course, in-depth, high content, high quality education. We're always here for you. Connect with us at any time. Our support team are always able to help. Trade safe and see you again soon. Bye bye for now.